There's a chart that I want to show you, and it's the chart that tells us most really right now about what is going on in the stock market. And what that means is how it's going to impact people's portfolios, whether they are working, getting close to stop working, or fully retired. This chart gives us really that direction of, okay, is the market going up? Is the market going down? Is it going sideways? Is it lost? So let's get to that chart. Okay, stick around. All right, everybody, this is RC Peck with Fearless Wealth, and this is my weekly review where I look at one or two, maybe three price charts. But really what I'm doing is piecing together the story of the market, which really is the story of someone's peace of mind or feeling of control over their life, especially when you stop working, right? When you eliminate active income, the performance of your portfolio is the most important. And think about that. You're probably taught just the opposite by your advisor, right? You go really aggressive in your 40s, maybe even 50s, and then all of a sudden your income goes away, your active income goes away, and your advisor puts you in some pretty lame performing investments, which is really weird because, you know, in your 60s and 70s, that's where the performance matters most. So we fix this problem at Fearless Wealth. If you're curious what that might look like for you, you can just go into the description and get on our calendar. Okay, let's jump over to the two charts that I want to show you this week. So here's this one, and there's a lot going on, so just give me a moment to describe. There's two charts on the screen. The bottom chart is the S&P 500. Okay, so we're looking at about 5 years of price. And the bottom chart is the S&P. The red vertical range area, that's just showing where the S&P had noticeable falls, right? So we got a noticeable fall of about 20% at the end of 2018. Of course, we have the COVID crash of 34%. And then the fall in 2022 where the S&P fell 25%. So that's where the red zones are. Now the top chart, okay, this is simply looking at all the stocks on the New York Stock Exchange and just going, look, how many are rising in price to how many are lowering in price. So if the top black line is going higher, that means more stocks on the New York Stock Exchange are moving higher. Okay, so what I want you to notice is, let me come over here, this zone on the top chart. Notice how here, if you can see that, it bottomed at the pre-COVID high. Right, so what we're having here is we're having a market that is literally going sideways, right? Not more stocks are falling, not more stocks are going up. It's literally this sideways market in how many stocks in the New York Stock Exchange are going higher to how many are going lower. We're in a sideways mess, which is what I've been talking about now. I talked about how, and I've changed my view because the evidence changed, that I believe the October low in the stock market is the low. It's a significant low that if it breaks, things are really bad if it's breaking. So we're going to have that be the low for now because it is a significant low and a low that looked very different from any other low in 2022. But what I want to show you most importantly was just this top price chart showing you that even new highs to new lows in the NYSE, NYSE, New York Stock Exchange, is sideways. So we are in for more sidewaysness. Your approach, especially when you're retired, should absolutely take this into consideration. You know, kind of the static, just give me 60-40 or a static portfolio that has no idea what's going on in the market, honestly is very 1950s. It's very modern portfolio theory, which came out in 1952. So please get your portfolio updated and have it start to respond to what the market is actually doing and not from a paper 70 years ago. So the advanced decline is saying we are in for more messiness, more sidewaysness. And sidewaysness is just a really hard thing for people to handle because it's not a clear direction. What I want to show you here is this is the iShares US Home Construction ETF. Right, so we talk a lot, people think a lot about the value of their house, what's going on with real estate, which makes sense because it's the largest asset class on the planet, real estate being the largest asset class on the planet. And for general purpose, think of the stock market being worth about 100 trillion, the bond market being worth about 200 trillion, and think of the real estate market, both commercial, residential, all of real estate being worth about 400 trillion. So real estate in many ways impacts people a lot, in many ways, but not in all ways, because if your house falls in price by 25%, it's not like you don't see, or 25% of the house goes away. You still see the whole house there. But what I want to point out here is even housing hit the bottom, which was the pre-COVID high. So this was the pre-COVID high for housing, or at least for ITB. And so you can see that the price of ITB came down to that pre-COVID high and buyers came in. And so what you also have even with housing is in a sidewaysness. Now there's a lot that goes into housing. The 30-year mortgage rate has a big impact. It's getting close. It's getting almost back to 7%, but not quite back to it. So I think eventually 30-year mortgages drop to 5%, which is something the market could absolutely digest. But rates are kind of moving up again. So what I want to show you is even the advanced decline is going sideways. We're in for a sideways market, which has a lot more anxiety if someone does not have an approach that really responds to what the market is doing. Now, my little bonus thing I wanted to provide, because I talked about Blackstone before, their B REIT, and how it is just, I don't want to say mismanaged. I don't know enough about REITs, but there seems to be a lot of questions going on with how Blackstone managed their B REIT. So I just saw this today. Blackstone just defaulted on a $500 million loan. Okay, $500 million loan backed by a portfolio of mostly office buildings. So that's not good. I mean, look, Blackstone has some of the smartest people in the real estate industry. So they deliberately defaulted on that, meaning they did the math of should we default, should we not default? And they decided to default on a $500 million loan. I don't know if the bottom's in for B REIT or not. It's not publicly traded, but it certainly does not look good for Blackstone. And Blackstone is still in a downtrend. Let me just quickly show you Blackstone's price chart. Come on. Come on. Let's get Blackstone up here. Okay, there's Blackstone right there. Still in a downtrend. If you look over to the right part of the chart, that downtrend has not stopped. Now it's near the up. I was going to say the upper part. Let me just zoom in here. Let's zoom into Blackstone. So what I mean by it's still in a downtrend, let's get this over here, is this, right? So the highs are still getting lower and the lows are still getting lower. We're not seeing this in a lot of the other parts of the market. So this is definitely weakness with Blackstone. I think they got over their skis. I think they got too aggressive, maybe too arrogant, but they have not broken out of their downtrend yet. Okay, so let's talk about putting a bow on this and finishing it up. The market is digesting a lot of information. It's always digesting a lot of information. But the information that's hitting it now, it is really trying to figure out, do we go up? Do we break out to new highs? Do we go down and test those lows in October? And the answer is they're digesting the information, and we're looking at a sideways, messy market, and that's going to continue to happen, especially with the Fed saying they may raise their federal funds rate past 5.25%. So that's going to put even more pressure on stocks and more pressure on bonds. Basically, more pressure on every asset class on the planet, except maybe the US dollar. It will help. But there are a lot of pieces of information hitting the market, and that's why we have a sideways market. Now, let me know where you think I got it right, where you think I got it wrong, what I missed, maybe what you're seeing that I'm not seeing with these price charts. The most important thing is to retire strong, which means not having that knot in your stomach, right? Getting control back over your portfolio, even if you're not managing it. But a lot of people are stuck in that 4% a year kind of return, and they don't understand why. We fix that problem. Thanks for being in my world. Subscribe, like, leave a comment. It all helps the algorithms, or not. Thanks, and I will see you next week. Okay, bye.